Hello everyone and welcome to the channel. Before you buy an ETF like QYLD, you need to watch this video because there's something a lot of YouTubers haven't been telling you, which I'm going to tell you in this video. So as some background, I've been seeing a lot of videos praising, as you can see right here behind me, QYLD as the ultimate dividend ETF. And QYLD, for those of you who don't know, is the GLOBAL X NASDAQ 100 Covered Call ETF. Essentially what this ETF does is it buys up, as you can see here, most of the major tech companies on the NASDAQ 100. There are a few other companies there as well. It's the NASDAQ 100, but mostly tech companies. And then after buying positions in these stocks, they sell options contracts on top of all these positions to generate income. You know all these really complicated videos about options on YouTube trying to teach you how to make income selling options contracts? Well, this ETF does that for you, sells options contracts on major companies on this big basket of stocks, and then passes on the premiums from those option contracts to you, the investor, in the form of distributions every single month. That way you don't have to be in your brokerage micromanaging options contracts or taking a PhD level course in the options Greek letter equations just to make some easy passive income. I admit it's a very powerful concept for an ETF, and I can see why people are drawn to it. Investors who are looking for a quick way to get easy passive income and a high yield are drawn to QYLD. Wanting to do this is fine, but many videos aren't telling you about the safety risks and downsides of QYLD, which I will be explaining to you in this video. I'll tell you up front, QYLD suffers from the biggest poison pill of dividend investing, which is return of capital, but we'll get to more of that later. The important thing is that if you don't hear what I'm going to tell you in this video, you could have a lot of pain later when you try to sell QYLD. I know all this because I used to own QYLD many years ago, and over time I've learned a lot about this ETF. QYLD can be safe, but it's like playing with fire, and you need to be armed with the right knowledge and tools to make it through. There's a way to generate income from QYLD, there's a way to play with this stock, but it's not what most YouTubers are telling you. So why do dividend investors and passive income seekers love QYLD so much? Well, they point out obviously it has a very high yield, which is 11 to 12% depending on what website you look at or what brokerage you're using. And you can see here it's a monthly dividend stock. Paying monthly potentially looks like this ETF could pay your bills and living expenses. This isn't one of those stocks where you have to wait a quarter just to get your dividend payment. Even the biggest skeptics are disarmed after looking at QYLD's dividend history, right? People might say, well, the yield is so high, that must mean that the dividend isn't safe, that they're about to cut it, something's going on here. But when you look at the dividend history, you see, yeah, it's pretty consistent and reliable, starting off at 17 cents per share distribution, going all the way up to 23. Overall, this distribution looks pretty stable, and it hasn't moved a whole bunch over the years. There's no big cuts. There's got to be more to this, right? Well, let's look even further. Let's look at income projections if you happen to own QYLD. Here we are on TD Ameritrade's income estimator for QYLD. And if you look at it, if you have $1,000 invested in QYLD, that pays you almost $10 a month in distributions, with an estimated annual income of $118. $10 a month might get you fast food once a month. That's something to start paying bills. But let's look at something else. Here we have $10,000 invested in QYLD, and now we're getting somewhere. You're making almost $100 a month in distribution, and just for putting in $10,000, which many investors have more than that, you're talking $1,100 a year in distribution. That's starting to look like real passive income. But now let's take it even further, because there's some investors who have their entire portfolio in QYLD. And you have to admit, if you don't know better, this is looking like the ultimate stock, right? Share price is stable, paying you an 11% distribution, the distribution is stable. It's starting to look good. What's going on here? Let's bump it up now. Here we have a potential $50,000 invested in QYLD, and now you're looking at, wow, $490 a month in distributions. That's every single month. That could seriously start paying bills. These distributions are passive income incarnate. What's even better, at over 11%, that's averaging out to about 1% per month in returns, which is crazy. Now, why do I, as an investor who's been living off of multiple passive income sources on the stock market and from dividend stocks and ETFs, not like QYLD? Well, you can take a look here. Here are all my dividends and distributions I received in 2020. I've been semi-retired since my early 20s thanks to dividend and passive income, and trust me, I figured out how to do this without $1 million portfolio, although I'm getting there. It's hard for me to recommend QYLD, especially because I can't recommend QYLD without first telling an investor looking for passive income about a small 3-word phrase. You have to understand this if you want to have success investing in QYLD, and those 3 words are return of capital. To understand return of capital, we have to understand how dividends are taxed, and believe me, it's shocking how many videos talking about dividends don't even take taxes into consideration. If you're trying to build an income portfolio, tax should be your #1 concern. Which makes sense because every dollar you earn in distributions and dividends has a tax attached to it. Too many investors only look at the income side, and now the true enemy of passive income, which is tax. If you turn a blind eye to the tax man, your poor fledgling dividends will be preyed upon like Fortnite noobs running away from professional Fortnite Twitch streamers. You don't stand a chance. Dividends are taxed in two ways: ordinary dividends and qualified dividends. Either qualified dividends, which are the good kind, or ordinary dividends, which are the not so good kind. So here we can see a chart of ordinary dividend tax rates versus the qualified dividend tax rate. And immediately you can see the difference between the two. So if you have $0 in income, at the qualified tax rate, you're actually paying $0 in taxes on your qualified dividends, up to $18,000 per year. But with ordinary dividends, you can see it scales with your income. And obviously every state income tax is different. But at a pretty standard salary to the $18,000 to $75,000 tax range, you're getting taxed at up to 25%, and it even goes higher than that, reaching all the way, you can see down here, almost 40% in the ordinary dividend tax rate. Qualified, you can see that right here. It stays at 15% for most of it, and at worst only caps out at 20%, right? So 20% for your tax rate is the same as for ordinary dividends earning just above $39,000 a year. You can see the power of qualified dividends. Now, what is a qualified dividend? Only a few companies actually qualify for qualified dividends, so everything outside of these usually pay ordinary dividends. So in order to qualify, the company you're investing in must be a US company or a qualifying foreign company. You can see right up there above my head. And you have to have held the dividend stock for the holding period, which is usually 60 days. So putting it really simply, dividends are taxed in two ways: qualified dividends, which are taxed at a fixed lower rate, which we saw before, and are considered a long-term capital gain. But there are rules for certain companies and certain holding periods in order to get qualified dividends, which means that a lot of REITs, BDCs, and even some ETFs and other dividend payers don't get this special tax treatment for the most part. They tend to have higher yields, but often those higher yields are considered ordinary income, which if you earn a lot of money are really just above $19,000 to $30,000, your tax treatment is going to be worse. You're going to pay a lot higher taxes on those dividends. Ordinary dividends are taxed just the same as your normal work paycheck. Ordinary dividends are fine if your income is low, but you can see in the higher tax brackets, it gets painful. Which, by the way, many successful investors or people with large portfolios are usually in a higher tax bracket, and that rate far exceeds the qualified income tax rate for dividends and distributions. So generally, for the best tax treatment on your passive income, you want qualified dividends, not ordinary dividends if you can avoid it. And this is just federal income tax, by the way. Some states also tax your dividends and distributions. Now for QYLD, QYLD doesn't even technically pay a dividend. It actually pays you a capital distribution, which is another term for return of capital. The biggest poison pill of dividend investing. Return of capital means that when QYLD pays you its distribution, it's actually technically giving your own money back to you. Each distribution on paper lowers the amount of money you have invested in QYLD and reduces your cost basis. The upside of this is that QYLD's distributions, as you can see here, aren't even taxable. That's true. If you get a distribution from QYLD and you follow certain rules, that distribution isn't taxable, which sounds great, which sounds amazing, but here's how it works. The government looks at it and says, well, you invested into QYLD, but when you invested, QYLD just handed the money of your own investment back to you, so that wouldn't be fair that we as the government taxed you. So you can keep it. Just know that because you received some of your investment back, your cost basis, which is how much you invested in the stock to begin with, is going to go down instead. So look at it this way. Say you have $1,000 invested in QYLD and you get about $110 in distributions from QYLD over the course of your first year investing at the standard 10 to 11% yield that many investors in QYLD are staring at like it's the woman in the red dress from the Matrix. They get distracted by that yield, but there's something going on here and you need to pay attention. By the end of the year, the value of your position after you have $1,000 invested, you get $110 in return of capital distributions from QYLD. By the end of the year, the value, as far as tax treatment goes, of your position in QYLD on paper is actually now only worth $890 because you got $110 of your own investment money back. Now, how do I know this, right? So here's QYLD's, you're looking at it right now actually, Form 8937, provided to investors to help understand their tax responsibilities. So you can see here, for the entire year of 2020, 100% of QYLD's distributions were return on capital. 100%. As many sharp listeners are probably guessing, you can actually bring your cost basis in QYLD all the way down to $0 if you receive enough distributions, which by the way, at the rate of 10 to 11% would probably take 10 years, but still, if you reach that point where your cost basis in QYLD reached all the way down to 0, your distributions would be taxed at the ordinary capital gains rate, which if you remember from before is the worst of the two tax treatments. Remember, qualified is better, ordinary is not so good. So at this point, it would be like, on paper, as far as the IRS and your brokerage is concerned, it would look like you paid $0 for your $1,000 in QYLD shares. So it would look like literally you got every single share that you paid for, which was $1,000 by the way, for free. Meaning that if you sold it, they would say that every single share of QYLD you own, despite paying for them fair and square, is pure capital gains profit. So if you think about it this way, if you sell QYLD at the wrong time or do this the wrong way, you can own QYLD and actually never come out ahead when it comes to income, right? Because you could lose money overall if you made bad timing on a sale due to taxes. Let's look at it this way. Again, you had $1,000 invested in QYLD. Let's fast forward 10 years now. You've paid off your entire cost basis and distributions from QYLD. So you've received $1,000 in distributions from QYLD. You have $1,000 invested in the stock, but when you go to sell QYLD, they'll say, okay, well, so luckily you held this for 10 years. So that is the long-term capital gains rate, which varies depending on your income. But let's say that's 20% you're selling at. You actually only receive back $800 worth of QYLD stock. Because you've lost now $200 out of that $1,000 to taxes, to long-term capital gains taxes when you sell your physical shares. Because the government thinks you literally got every single share of QYLD for free. It's 100% pure profit. So if you do the math, you invested $1,000 into QYLD, you got $1,000 in distributions, but when you sell your shares, you actually only get $800 back. So you're not really coming out as far ahead as you thought. Overall, after holding QYLD that entire time, you gained $1,000 in distributions, but you lost $200 in long-term capital gains at a 20% tax rate. And by the way, it gets worse. If you put those two together, you've actually, over 10 years, only come out with $800 in distributions, $800 in true income, because you lost so much from your cost basis. This, of course, is assuming that the share price of QYLD stays the same. Now, if you were to get impatient and sell QYLD even faster, here's what would have happened, right? So you sell just before the cutoff in short-term capital gain, you got about $100 in distributions, and you go to sell your QYLDs. The government would say, okay, you have $900 worth of QYLD stock, you're selling it at a short-term capital gains rate. The government would say, okay, so you bought about $900 worth of QYLD stock even though you paid $1,000 for it. So you have about $100 worth of capital gains. This is the short-term capital gains bracket, so depending on your income, it's going to vary. But let's say you get taxed at 24 to 30%. That means you pay taxes between $24 and $35. So if you subtracted that from the distributions, that means you're only netting about $70 to $80 in actual gains on distributions. So you can see with tax treatment, it's complicated, but there's a lot to QYLD that's actually quite dangerous, especially if you make a lot of money and you sell at the right time. I mean, let's talk a worst case scenario. At about a 32% short-term capital gains rate, that means you would lose just by selling 32% of the value you collected in distributions. Because every distribution you receive from QYLD makes the pain of selling QYLD later, if you want to say free up the cash for another investment, much harsher, because every distribution you receive potentially raises your tax bill when you do sell QYLD. So if you don't consider these strategies I'm about to tell you, you could end up holding QYLD for a year, just below the long-term capital gains cutoff. And if you want to sell those shares to, say, invest in something else, you're actually going to find that you weren't really collecting an 11% dividend this entire time. No, in fact, you were collecting a return of capital distribution, and now own a large tax bill when you sell QYLD, taxed at more than you would pay for other stocks and ETFs. So how do you get around this? There are a few strategies, but none of them are perfect. So the first is you can invest in an IRA, right? So you can put your QYLD shares in your IRA, and that way you won't pay tax when you sell it, which is good. The downside, of course, is that you can't access this dividend income in your IRA tax-free until you're at least 59 and a half years old, which is defeating the purpose of bringing in real current income, right? Many passive income investors don't want to wait that long, because the point of passive income is you want to retire early. So this strategy is good from a tax perspective, but from a time perspective, there are definite downsides. The second way to deal with this problem of taxation from QYLD is to buy more QYLD shares to keep your cost basis up, right? So you could reinvest the distributions you get from QYLD, or just put in more money to buy QYLD to keep your cost basis up so it doesn't keep going down. But this is kind of like pumping water out of a sinking ship. You aren't changing the fact that your cost basis is still going down by every distribution, you're just offsetting it by pumping in more cash. It's not really addressing the underlying problem, but I can see why some people would turn to this strategy. The third option you have is to never sell your QYLD shares, and after your cost basis reaches zero, just pay the ordinary capital gains dividend tax, and never sell your underlying shares so you don't pay capital gains tax on those shares. But then you're thinking, okay, if I have so much money invested in QYLD, my cost basis keeps going down, and if I sell, I have a big taxable event. How do I get that money? Sometimes I want to invest in something else. You can take out a margin loan against your QYLD shares. So think of it this way. Let's say you have $10,000 in QYLD. You can access the money you have tied up in QYLD by taking out a margin loan worth the same amount as your shares, which is $10,000. So that way, sure, you have a margin loan, you are going to pay some interest on it, so it's collateralized by your QYLD stock. So if you really had to deal with that margin loan, you can sell it because it's not like you're taking out a loan per se, you're just accessing that money you have tied up in QYLD, and that way you don't have to pay the tax after selling your QYLD shares. So that way your distributions from your QYLD shares can continue to roll in, and you can access the principal, the money you have invested in QYLD, without triggering a financially eviscerating tax event. None of these options are really ideal in my book, but those are strategies I've come up with. Be aware, if you own QYLD, you are chained to it, and if you sell, from a tax basis, you will be hurt. Of course, there may be other strategies that you can do when you're invested in QYLD, so of course remember that this video is informational, and you should take it as is. I can't guarantee the accuracy of all the information in this video about even the tiniest aspects of QYLD. This topic is extremely complicated, and every investor situation is different. You can just see every income's tax bracket is different just on the surface level. So you can tell just how complicated it is to talk about QYLD. For tax treatment and tax guidance, proper guidance, you have to seek licensed, qualified investing and tax advice and do your own diligence. I am not that. I am obviously not a qualified investment advisor, and I am definitely not a qualified tax advisor. Do your own diligence, especially when it comes to tax. It is so important and so dangerous if you do it the wrong way. Especially if you're trying to build an income stock portfolio. Get the proper tax advice. Income and tax go hand in hand, so don't forget this. Thank you for watching this video, and of course, giving me consideration and listening to what I had to say. If you were a fan of QYLD, I appreciate you having an open mind. I know a lot of people get attached to their stocks, and honestly, I am just trying to help you. I went through these same troubles with QYLD, and I want to prevent other investors from falling into the same pits that I did. So if you want to help out the channel, if you want to get started investing the right way, I have two links down in the description. One is to the brokerage M1 Finance, where you can buy ETFs like QYLD. I highly recommend that brokerage for beginner investors. It's very easy for long-term, passive, hands-off investing, and I'm a really huge fan of the platform. So when you sign up for M1 Finance using my link, when you deposit $100, you get $30. So that's an instant 30% gain just for starting investing. I, of course, get a tiny little kickback. I also get $30, and it helps out the channel, and I really appreciate it if you use that link. Of course, you don't have to, and please consider all the investing apps and brokerages out there. Now, if you're an intermediate investor, and you don't want to just invest passively, you want to be in the game and go a step further, for intermediate investors, I recommend Webull. There's a link down in the description. If you use that link to sign up, you get 2 free stocks. I get 2 free stocks. Helps out the channel a little bit. I like Webull for intermediate investors because it gives you more detailed analytics and charts that you just don't get in other brokerages. Webull really is an excellent platform. It's so powerful. It has so many tools and so much information that normally you'd have to go chasing around the internet on random websites. Highly recommended. Thanks for watching this video, and I will see you next time. Salute.